Hi, I'm Jenny Brown. Welcome to MFB News. How's your week been? Really good, I hope. We've been really busy actually. I'll come on to why in a moment, but it's been probably the busiest week that I've ever known in terms of new applications. Really good for us as a business. This weekend I'm going to recover by drinking a huge amount of alcohol and hopefully sleeping a lot. Now, in terms of what we've got for you today, we've got our usual update on what's been going on with the lenders. We're then going to be covering off some reporting that's been coming out in the market, which has been really interesting. So first thing we're going to look at is how many property transactions are now going through, which is a really good indicator in terms of where the property market is headed. We're then going to be talking about renting or buying, which one is cheaper, and the pendulum does swing on this one in terms of which one comes with the lowest cost, and I'm going to be letting you know where we sit with that at the moment. And then lastly, there's been quite a lot of kind of murmurings in the press in terms of actually is being a buy-to-landlord a viable business proposition any longer. So we're going to be talking a bit more about the information, the data that sits behind that question, and actually where the market really sits, and really, I guess, what the answer is to that $1 million question at the moment. Okay, lenders. Wow. Okay, so just to kind of give you the preamble to what's been going on. So swap rates have spiked again. They're at over 2.8%, which means the cost of funds on the money market has gone up, which means that lenders' cost of funds has gone up, which means they need to increase their pricing. Otherwise, they're going to be lending it to you guys at a loss. We don't want lenders to lend at a loss, because if they lend at a loss, they stop lending, and then there's nobody offering buy-to-let mortgages. The competition comes down and pricing margins become even higher. So lenders are simply responding to the cost of the funds on the wholesale money markets. So I know everybody at the moment is like, oh, they're robbing lenders and all this kind of stuff. I do actually get the sentiment, but actually the reality is the lenders are just kind of trying to make sure they have a viable business model. So with that in mind, there's been a large number of lenders repricing. Actually, it might be quicker to tell you who hasn't repriced this week. So we're seeing rate increases from Clydesdale Leeds, Platform, Paragon, Zephyr, Precise and Kent Reliance. Now, not only have they pushed up rates by 0.6%, but they've actually removed temporarily all 75% loan-to-value products. So at the moment, Kent and Precise are huge players in the buy-to-let market, don't have any 75% loan-to-value rates. They will bring them back in. These lenders are super busy at the moment. We know they're falling behind on service. They've obviously pulled the plug on this for the time being, just to slow business volumes down so they can get back on top of things, but really indicative of kind of where the market is there. Other price increases from Accord and TML. Now, those that I've just given to you all happened yesterday, just to kind of give you the scale of what's going on here. So that was Thursday's changes. In the other 4 days of the working week, we've seen BM Solutions increase by 50 basis points, Leeds by 45, Barclays by 45, Virgin by 40, Coventry by 55 basis points. We've also seen Kensington, CHL, Lendinvest, Skipton, Pepper increase rates, Vida Home Loans by 0.5%, Landbay by 0.4%, Fleet by 0.5%, and Keystone. So 24 lenders have repriced upwards in the last week. So where does this leave us now? So personal borrowing, first of all, 2-year fixed rates from 2.49, 5 years from 2.65, 7 from 3.6, and 10 from 3.75%. In the limited company space and specialist end of the markets, the limited companies, landlords with portfolios of, generally speaking, over 10 properties, HMOs, multi-units, you're looking at 2-year fixed from 2.54, 5-year from 2.89, 7-year from 3.6, and 10 from 3.8. What's really interesting here is right now, as a moment in time, the price difference between limited company and personal borrowing as small as I've ever known. It's 7-year fixed rates of parity. Price difference between 10-year fixed rates, personal is 3.75, limited company 3.8. It's a 0.05% difference on interest rates. Generally speaking, in normal times, we're talking about between sort of 1 and 1.5% difference on rates. So the rates, actually, the margins, or the difference in cost, should I say, between the two is actually incredibly low. So what's the message here? So look, we are still seeing more lenders reprice. So of the 24 that have repriced, we're looking at the other lenders who have not yet repriced, and those guys haven't repriced for a couple of weeks. So there's another round of repricing on the cards in the next few days. I'm absolutely certain of that. It is incredibly difficult when we're speaking to clients and we're giving them a rate on Monday, and they call back on Wednesday or Thursday and say, actually, I want to go ahead with that rate. And we're saying, well, I'm really sorry, but it's actually gone up by 0.5%. And it's really actually very difficult for clients to get their heads around that kind of large change in such a short space of time. But that really is how the market is at the moment. So my message hasn't really changed from the last few weeks. If you do want a mortgage, you found a rate that you can kind of work with, just jump on it and go for it straight away. Do not delay, because honestly, even 24 hours can mean the difference of 0.5%, which if you're doing a 5-year fixed rate, that's a 2.5% increase overall. So time really is of the essence for you. Okay, now in terms of property transactions, so the UK residential transactions totaled 100,870 in the last month, which is 2% lower than the figure in May last year, so in 2021, but is 1.6% higher than in April 2022. And this is according to the latest HMRC property transaction data. So HMRC have also reported that the number of non-residential transactions was 10,250 in May 2022, which is around 9.7% higher than the previous year and 0.4% higher than the previous month. So what we're seeing here is that after a slight dip in April, the number of property transactions has increased again, with over 100,000 homes being sold in May. Now, the market is, according to experts, continuing to defy expectations that a slowdown is looming. And it does appear that the increases to the cost of living and interest rates haven't yet deterred people from finding the right property. However, what experts are saying is that we may definitely see this start to slow down as things really do start to bite, so the higher interest rates really start to come through. So looking at this data, if you imagine that in May this year, we're seeing an uptick in the number of property transactions compared to April. But if you completed on a transaction in May, then realistically, probably you put the offer in on your property in December, January of this year, possibly even before that. And that is before we had a war in Ukraine. It's before we saw the interest rates really going crazy. So actually, probably what we are still seeing is the kind of last shakings out of everything going absolutely nuts. And actually, when things do start to bite, and actually if we were, in 5 months' time, it will be interesting to see how the data looks there. But I do suspect we're going to see the number of property transactions is eased right down. Does that mean the housing market is dead? Absolutely not. As reported in previous weeks, what we are seeing is a slowing number of properties coming to market, but still the number of people registering to buy property is still really, really high, so higher than in pre-COVID times. So there's still very much a very strong demand for properties that come to market. There simply isn't as many of them for sale, which means that actually this is going to continue to drive up house prices, at least in the short to mid-term. Okay, so buying or renting, which one costs less? The Hamptons have released their latest lettings index and have provided some really good commentary around this. This is how it's shaking out at the moment. So the average rent in Great Britain rose by 11.5% annually to £1,152 in May. This is equivalent to £119 per month higher than the previous year. It marks the first time that rental growth has hit double digits since Hamptons started recording this data back in 2012, so 10 years ago. And this latest double-digit growth surpassed the previous record rate, which was set last month at 9.8%. So Hamptons noted that with rents rising quickly and mortgage rates near historic lows, for the last 11 months, it has been cheaper to buy a home in Great Britain than to rent. In May, it was £40 per month cheaper to service a mortgage with a 10% deposit than it was to rent the same home. While in November 2021, it was £160 cheaper to buy than to rent. However, if last week's 0.25% base rate rise is fully passed on to mortgage rates, then it's going to reverse this trend and make renting a home £1 per month cheaper than buying on a monthly basis. And if we see further base rate increases, which we are expecting over the coming weeks and months, then obviously that will push things further in favour of renting than buying in terms of monthly outflow of cash. Now, there are some regional differences to this that Hamptons have gone into. So what they're saying is, for someone with a 10% deposit, it's typically cheaper to rent than to buy further south, while further north it is generally cheaper to buy than to rent. And I think that's kind of obvious when we think about yields. So obviously those areas which have the higher yields are going to be more expensive to rent in. If you've got a lower yield in the southeast, it's obviously notorious for low yields, then that would kind of explain it away. But what I think it does is actually just kind of really illustrate how when home buyers are looking at buying or renting, actually, the historic thing is always, God, well, it's cheaper for me to buy a house than rent one, so why on earth would I buy? But actually, if it's going to be cheaper for people to rent than to buy going forwards, and that's going to really kind of make sure that more people stay in the private rental sector for a longer period of time. So when I see an article which has the headline, "Is buy-to-let a viable proposition any longer?" obviously I'm going to read it. And actually the article that I read was really interesting. Now, there have been other articles published along these lines in the last couple of weeks. There was one in the Times which I think set the cat amongst the pigeons amongst landlords. But this one I thought was really good, so I'm going to share it with you and I'm going to offer up my views on some of the commentary. So the viability of the residential buy-to-let business model has been called into question by Arona Havenko, who's an equity research analyst of real estate, housing and construction at Bloomberg Intelligence. So Havenko has said the model is seeing some difficulties, with private landlords facing much higher tax bills and other hurdles, including the need for costly energy efficiency upgrades triggered by legislation changes. So this, combined with prohibitive transaction costs resulting from hefty stamp duties, may curtail the UK's buy-to-let market, she has said. She went on to explain that there has been an exodus of landlords from the sector, leaving with the intention to sell. Now, Property Mark have released some data which shows an accelerated outflow from March 2019 to 2022, as 84% of landlords that withdrew their property from the rental market in those 3 years did so to sell. And they have said that this is likely a result of the tightening regulation that has drastically curbed returns. This has led to 49% fewer rental homes per estate agency branch in March versus the same month in 2019. Now, I'd just like to pause for a moment and go through some of this information. So first of all, what we're saying here is that between March 2019 and March 2022, the pandemic years, 84% of landlords that withdrew their properties from the rental market in those 3 years did so to sell. Now, absolutely, without a shadow of a doubt, during that period of time, and even still, now that our landlords who are actually looking to divest, is this a result of the tightening regulation, the tax changes and all the rest of it? Yeah, sure, absolutely. There are landlords who have just basically got cheesed off and had enough. But actually also during the period of lockdown, there were other things at play. So landlords, and we came across quite a few of these, who decided to sell a couple of buy-to-let properties, release some cash so they could then afford to move their own homes someplace else because they wanted a change of kind of lifestyle because of the pandemic. Also, there was some real nervousness about being able to re-let properties as well because of the kind of restrictions on people moving house during the early days of the pandemic. And finally, actually, some landlords decided to sell just because house prices were going so crazy. They just felt that actually, if you're going to sell your buy-to-let, when there's a stamp duty holiday on and everyone's going absolutely nuts to buy property, this is a pretty good time to do so. So lots of different factors at play. I do acknowledge what they're saying and I do agree with it to some extent, but I don't think it's purely that landlords have kind of had enough because of regulation. I think there's other factors at play here. Now, the other thing that they've said is that there are 49% fewer rental homes per estate agency branch in March versus the same month in 2019. So what this means is that essentially estate agents have got less property rent out, which again is showing a shortage of supply, which is pushing up the, or therefore it can't kind of keep up with demand, which is pushing up the rents. Now, why is this? So absolutely, so first of all, we have seen landlords, for the reasons we've just discussed, looking to sell property. But the other thing is that actually there are less properties to let in estate agents because people are staying longer in rental properties. They're not moving around as much. There's not as much churn. So this means that there are less new instructions as well. So that also is contributing to what's going on here. Okay, so back to the report. So she said that while tougher buy-to-let rules were meant to help first-time buyers by reducing competition from property investors, the legislation may have backfired as limited rental stock drives steep rent rises, meaning prospective buyers may find it tougher to save for deposits. At the same time, Havenko said the demand for rentals may increase, giving the stretched housing affordability and mounting economic headwinds, which could deter some buyers. So essentially what they're saying here is that actually, I think almost the message from me here is hold your nerve. So those landlords who are kind of sticking in the market and actually kind of, you know, carrying on regardless, terribly British approach, isn't it? These guys are going to do okay because actually there are more tenants who are going to be sort of, it sounds awful, but struggling to buy properties, maybe deciding that now is not the right time to buy a property because of the strong kind of, or the kind of challenges that we're facing at the moment. So genuinely, actually from this report, which is meant to be kind of quite a negative thing, I actually see some real positives here in terms of, you know, for those landlords who do have buy-to-let properties, I think actually reletting and sustaining your yields is going to be very, very possible in the coming weeks, months, and even years coming up. That is everything from me this week. Thank you so much, as always, for taking the time to have a watch or listen. I do hope you found that helpful. And as always, on the back of this or just anything mortgage related, if you have questions, we would absolutely love to hear from you. 0345 345 6788, or have a look at our website, mortgagesforbusiness.co.uk. So that's it for me. I just want to wish you an amazing weekend, and I will catch you again same time next week. Take care.